Hello, everyone, and happy fall. I'm Dana Hastings, Director of Wealth Management in Cleveland, Ohio. We're welcoming clients from all of our offices today, including Cleveland, Chicago, Harrisburg, Pennsylvania, Buffalo, New York, Princeton, New Jersey, and a very warm welcome to our newest team from Cherry Hill, New Jersey. We thank you for joining us on this Friday afternoon. And as always, it is our pleasure to serve and inspire you and your families. We host investment town hall webinars on a quarterly basis with the intent to connect you directly with our Chief Investment Officer, John Silvas. Today, John will recap where we've been, his thoughts on where we are today, and his opinions on the future direction of the markets. We asked for your questions in advance, and John and his team have prepared slides addressing those questions and other frequently asked questions. Be assured that your advisors are in continuous contact with our investment team. There are many ways that you can be too. You should be receiving the quarterly Fairport Compass and periodic Fairport Perspectives via email. If you're interested in weekly updates, please ask a member of your advisory team to share our Fairport Wealth Market Note. That comes out every Tuesday. You can also subscribe to our Fairport Flash, a monthly podcast on Apple Podcast, YouTube, or Spotify. Finally, you can follow the hashtag Investing with Fairport on LinkedIn and Twitter for frequent thoughts on the markets and economy. As always, you're muted on this webinar, and we are unable to see your faces. If you have questions during the webinar, you can type them into the Q&A part of the toolbar, and we'll answer as many as we can, time permitting. With that, I'm going to turn it over to John, our Chief Investment Officer.
Thanks, Dana. Appreciate it. Yeah, it's been a busy quarter. I will tell you, you were rattling off some of the offices. I spent most of the summer with a lot of our colleagues kind of doing the road tour. I was in Princeton, New Jersey with our friend Yu for a client event. That was the day the smoke from Canada came down. So that was an interesting day. Spent 2 days in Harrisburg for a client event as well. And then just recently we did a client event with Mike and Deb in Buffalo Grove. So it's been a pretty hectic summer, and I'm kind of looking forward to the fall and watching a little more football as we go forward. But always happy to do those things, and if anybody ever wants us to come out, I'm happy to do that as well. So happy Friday the 13th to everybody. I know it's for most people they don't like this. For people my generation, Friday the 13th reminds me of the movies. But I will tell you, I met my wife on October 13th. So to me, it's a lucky day. So it was 34 years ago. So it wasn't a Friday, I don't believe. But anyway, so we have this ongoing debate between the two guys here. One believes there's a hard landing coming, and one believes there's a soft landing coming. I'm sure we'll have a lot of discussion about that as we go forward. If you watch anything on TV, that's kind of been the rolling comments, between the Fed and all the data that comes out. Does that mean a hard landing, soft landing? It seems to go back and forth, and we'll talk a little bit about it as we move forward. So I thought we'd just kick off going over the third quarter. As Dana mentioned, if you have questions, please type them in. We have a few that we've gotten in advance. I know Dana has a couple of her own, and I'm happy to answer those as we go. So, returns have been holding pretty steady this year. Third quarter was down slightly. The S&P was down about 3%, a little over 3% for the quarter. Bonds, believe it or not, were down about the same, about 3% in the third quarter of 2023, mainly because interest rates moved up. I think that actually hurt not only bonds, but also the stocks as well. But really, year to date, S&P 500, which is the large cap benchmark out there, is up about 13%. The ACWI, which is an all country world index, which is more of a global focus, is up about 10%, the exact 9.9%. Bonds are still trailing for the year. They're down 1.2%. You look at that column all the way to the right, it has, the year to date returns, and large caps are on the top of the list so far this year. Small caps, as you can see, that orange one about halfway down, have been somewhat muted for the year. They're up about 2%. This we are on the verge of perhaps seeing a third year where bonds will have a negative return. And when I talk about bonds, I'm talking about the Bloomberg Aggregate Index, which is kind of like the S&P 500 of fixed income. So we're kind of keeping an eye on that. If we see some declines in interest rates here between now and year end, that may reverse itself. But I wanted to kind of talk a little longer term. So over the last 5 years, and we tend to take a long-term focus when we're talking about the economy and the markets and investing for our clients. The S&P over the last 5 years is up 9.9% a year, so call it 10%, which is on the high end of what is usually the historical standard of somewhere between 8 and 10%. Bonds have eked out a small gain on an annualized basis over the last 5 years. It's only up 0.07% a year, so basically call it flat over the last 5 years. And small caps, which we talked a little bit about, of about 2.3%. So they've definitely trailed their large cap brethren. But again, I think when you look at it from the long term, I know there's a lot of talk about volatility, but on the longer term, equities have still been pretty positive. We've definitely entered a new bull market. The bear market bottom was just over a year ago on October 12th, so I think we're officially entering bull market territory. So far, we're up about, as you can see there, the red circle, about 20% off the low from roughly a few days over a year ago. And I do think there's further upside to go. Fourth quarter tends to be good, and we'll talk a little bit about that as we go forward. I know about a year ago we talked about this a lot, which was you tend to have a pretty positive return after midterm elections. So there's always a saying this time could be different. It's not something that I would bet the farm on, but I do think it has a historical trend to it. And just to kind of give you an update, the election was on November 11th. Since then, through 9:30 of this year, so we have a little bit over a month to go. Market's up about 13.8%. So, right in historical standards. And I think we'll see. It's our belief, and we'll talk about this. I think there's further upside in this market between now and year end. How much really depends on a couple different factors we'll talk about. And as far as fourth quarters go, they tend to be the best, one of the best quarters out there. November, December tend to be very good months. October as well. But if you go back and look at history, and there's 7 times this has occurred where we've had a positive year, but we had a decline in the month of September, which we did again this year. You would think, okay, maybe that's the peak, and the markets are going to kind of fade throughout the rest of the year, but that's not really been the case. October tends to be fairly positive. We had one year there back in 2020. And we also had a pandemic at that year, so there's a lot of things going on then. But if you look out over the fourth quarter as a total, October, November, December, it tends to be pretty positive, and you get on average about a 9% return. I won't guarantee a 9% return. We don't do that in this business, but we do think there's an upward bias, and I would always use the word, I think there's a tailwind kind of heading into the end of the year. And I think so far we're only 2 weeks into the quarter, but the last few days since the Fed announcement, markets have tended to drift higher here. So I kind of paused there. We're going to talk a little bit about the economy, but I know, like I said, we've gotten some questions. I don't know if there's any out there that you want to shoot me now, Dana. If they're economically related, we can kind of talk about them. I may have a slide, but I'll pause there.
Okay, I've got a few from the audience. The first one I'll start with is, with the world in so much turmoil and the political instability in our country, what advice do you have to weather the unknown?
Yeah, so there's this old saying about the market likes to climb a wall of worry, and that means that there's always something out there that's giving us pause. It's kind of hard to put it. You got to put it in 2 different spots. I mean, you have the human issue out there, which is the war and in the Ukraine, and obviously the conflict we're seeing in Gaza, Israel. But I think if you look back over time, you can go back to the Cuban Missile Crisis or the Vietnam War, the Gulf Wars, 9/11, oil embargoes, the Brexit, all these things that kind of create geopolitical concerns out there, markets tend to take them in stride. I don't know if this one will be different. I think sometimes they're a little worse than others. For example, on 9/11, we ended up going into a recession, which tends to have a little bit more of a consequence. But bigger picture, they don't tend to have a long-term uh, outcome on the economy. I think we'll talk about oil prices in a second here, but I think the one that we're probably most concerned about in this case, especially with the conflict in the Middle East, is where does that drive oil prices and those things. So I do think there's something you definitely want to keep an eye on. You want to be concerned about, but I don't think you want to make any rash decisions on your allocation longer term for some of these conflicts. And again, they tend to boil up all the time. I think we're always dealing with something. So I don't know. Again, I don't want to dismiss all the human tragedy that's going on, but I think from a market standpoint, it doesn't have as much effect as you would think.
Thank you, John. You want room for one more, or you want to keep moving?
Sure, go ahead.
Okay. All right, let's see. So we know you don't have a crystal ball, or maybe you do. But what are your thoughts should the November election bring a new change in the White House, along with House and Senate?
Yeah, so I'm going to defer on that question because I do have a slide later on about first-term presidents, and I'll talk a little bit about that. If I don't touch on it, let me know. But I think although it seems like we're ramping up already, we're more than a year away. I think that probably if there was one political issue, probably a little more pressing, would be the electing a speaker. We've been going, I think, a little over a week now, or about a week, give or take, without a speaker. To be fair, the economy seems to be running fine and the government seems to be running fine, but I think we're going to get caught behind on some of these budget issues and budget concerns as that continuing resolution that they passed to avoid a government shutdown gets closer. So that's a concern. But I have a couple of thoughts on the presidential election, and we'll circle back later.
Okay, but speaking of government shutdown, with that looming potential for a government shutdown in November, should we be concerned?
Well, again, government shutdowns are kind of like geopolitical events. They happen at times. They tend to, come and go. They do cause some short-term blips. Maybe there's volatility in markets that get somewhat spooked. I have a feeling, and it's just my own gut feeling from watching these things over the years, that there's not a lot of there's a few fringe players in Washington who would love to shut the government down, but I don't think there's a big consensus for that. And I would think once they get the speaker figured out, and my guess is they will over the next couple of days, they'll either pass another continuing resolution or they'll come up with some appropriation bills. But if a government shutdown does happen and it does tend to linger a long period of time, there's going to be ramifications to that. I don't think that's the base case right now, but that things in Washington can change fairly quickly and usually a pretty fluid event. So I think they have to get their house, no pun intended, in order, and then I think we'll see how that goes. But I wouldn't be too concerned at this point. And if it is a shutdown, you have to keep in mind it's only about 15% of the government that's really shutting down. A lot of it's already been pre-funded. So we'll see how that goes. But I'm kind of keeping a closer eye on the speakership, and then I think government, and then how they're going to react to that going forward. So we'll keep an eye on it, but I wouldn't be too concerned.
Okay, good. It's reassuring. Do you want to take any more, or should we just continue? And I've got lots of them coming in.
A lot of pauses in here. We can keep going, but let's move on to the economy. So I think, as I said earlier, there's been this tug of war all year about soft landing, hard landing. And if you go back to the beginning of the year, I think the consensus was, well, somewhere in the second half of this year, 2023, we would probably see some type of recession because of the tightening and the interest rate increases from the Fed. And it tends to take a couple quarters to kind of work its way through the economy. We did have that little bit of a blip back in March with the banking issues, with some of the banks have to be closed. The Fed put money in, so that was probably a stimulative effect. But anyway, as we look at it today, the third quarter isn't showing any signs of a recession. So we just ended the third quarter a week and a half, almost 2 weeks ago. So far, one of the things, and I show this quite a bit, and I don't show it because I want to be redundant. I show it because it's pretty consistent. The Atlanta Fed GDP now, and as you can see, that kind of greenish line there. Right now, they're predicting the third quarter GDP is about 5%. Now that could come down over the next week or two, but they'll come out with the final number in about a week and a half. And then the consensus out there from the JP Morgans, the Citibanks of the world is about 3%. Now, to be honest, the Atlanta Fed's been much more accurate than most of the street economists are. But I would say that there's a good chance the third quarter has grown above trend, which is 2%. Probably most likely closer to 3 or more. So far there aren't really any signs, at least as it relates to the last quarter, that we're seeing a recession. So that again, that tug of war between hard and soft landing kind of continues. One of the other things that we've watched, from our own standpoint, to try to get a gauge on where we think the economy is going is company surveys from Evercore. They do this on a weekly basis. It's a pretty consistent indicator, and it's kind of a real-time indicator. And I've mentioned this before, where there's that line in the sand there, which is the red line, which is 45. Right now they're around 50. Excuse me. It's still holding in there. It's definitely softened, as you can see, but it can take another 6 to 12 months before it gets down to 45, if it even gets there. So again, I would say there's maybe some softening in the economy, but I don't see that recession sign yet. And then a couple other real quick points. This is a map from, or a chart from Goldman Sachs. They've been pretty consistent on the soft landing approach, and they're one of the bigger investment firms out there. As you can see, that blue line in the bottom, they've actually reduced their probability even further. That there's only about a 15% chance of having a recession in the next 12 months. So, and we're still kind of on watch, but it looks like the probabilities are starting to decline some. And a couple other things that still indicate that the economy is showing some resilience is, the job markets. We saw over 300,000 jobs created in the month of September. They revised up the last two.
Oh.
Did I fade out?
I think you did.
All right, where
You're
did I
back.
fade out? Sorry. So anyway, I was talking about the job market, and it seems to be resilient. We've seen 336 jobs in September. I think it's still, I would say we're not anywhere near that recession level, which is probably job creation below 150,000 for several months in a row. And the unemployment rate is about 3.7%. So we're still looking pretty good. And then I think the one thing that's kind of starting to show some concerns is the housing market. And there's the big reason for that is mortgage rates. They're getting really close to 8%. In fact, I think they might have touched 8% at some point on a 30-year fix. So, the baby boom, not the baby boomers, the millennials out there, I know people my age and older have seen rates this high, but for millennials, this is way too high. They were buying 3% mortgages a year, 2 years ago, and now they're looking at 8%. So I do think that's having an effect on demand out there from housing. It's not that people don't want to move. They don't want to either buy an 8% mortgage, or they don't want to sell their house with a 3% mortgage to buy a bigger house at an 8% mortgage. So I think that's starting to have a little effect on the economy. But overall, it looks like inflation has peaked. I think it's likely peaked. I don't know how fast it'll go down from here. It's been bumping along in the 3% range. We had a pretty big move down, and now we're kind of moving sideways. But I think if you look out over the next couple months, gasoline prices are likely to come down. For whatever reason, gasoline prices tend to be the headline that most people look at as far as inflation goes. Prices of the pump come down, they feel better. Prices of the pump go up, they feel like things are getting bad. So there's a good chance, as you look at gas futures out there, that's going to lead to retail gas prices dropping. A couple other points on there. If you look at number 3, the apartment rents have started to decline in September. December. So we're starting to see that continue. So I would say, that the economy, the glass is half full, not half empty. I still think we're kind of hanging in there. I think we'll see some more data points over the next few months. And I do think we'll start to see the ramifications of the tightening from the Fed and kind of fall back towards that trend line about 2%, maybe a little less, but it's still up. It's still up in the air if we're going to have that hard landing where we go into another recession. So I'll pause there. Any questions you want to ask?
Okay, we got some good questions for you. First, I want you to know that I was in sheer panic. I thought I was going to have to finish this on my own. You don't want that. Second, this is a really good question from a client. And I'll preface it by saying I actually had another client who had a training in New York City scheduled for today that got canceled for security reasons. So, with a high probability that the U.S. will increase its own defense preparedness, what sectors should do well?
Well, the old saying, I'm going to butcher this because I'm not a hockey player, but was it Wayne Gretzky says, you want to skate where the puck's going, not where it is. And if you look back, I want to say it was Monday and Tuesday, the defense names like the Lockheed Martins and the General Dynamics and Northrop Grumman and a couple others had a pretty big move those days, mainly because people were anticipating higher spending. You basically have 2 theaters now, one in Ukraine and then one in the Middle East. And at some point, that's going to be, I hate to say it, but it's good for the defensive companies because of the use of all the artillery. So I guess the easiest thing would be to say that defense names are probably what would benefit the most, but I would argue that they might have already moved pretty quickly because of that. Now, if this gets prolonged, they could move more, but you're looking for the most direct outcome. That's probably one of the better areas to look. You can start looking at some of the periphery type of companies as well, but it's a tough question to answer because, like I said, the easy money may have already been made there because the market moved pretty quick because they didn't see it coming, and so they kind of filled the gap, so to speak. So, not a great answer, but that's my best answer for you.
It's a good answer. Good answer. And thus far, everything seems pretty encouraging. Let's see. Okay, if I ask a question about real estate, is this a good time, or are you going to touch on it?
Sure, no, go ahead.
Okay. So, well, we just saw the periodic table. Saw that real estate, has been a little beat down over the last couple of years. So, what are your thoughts on real estate right now?
Well, so are you asking about private real estate or public real estate funds?
We'll leave that up to you. You can talk about, how about both?
I think just in general, I don't know if the other shoe has dropped yet on the real estate market, and I don't mean that in a sense that there's some catastrophe on the horizon. I do think that there is a re-rating or reassessment of office space going on and how much you need and how often you need to be there. And I think that has kind of ramifications for a lot of areas. I'll give you a great example. We had a research firm come in a few days ago in our office in Cleveland, and we were talking about them. And I said, well, how many days a week do you guys go back in the office? Because I tend to ask that question a lot. And they had offices in Manhattan, and they said they don't have offices anymore. Their lease ran out, and they all just work from home now because it seemed to work, and they saved a bunch of money, and they get together like once a month, um, and that's it. So I don't. That's probably an extreme, but I do think there's people out there that are reevaluating what they need to do and how they need to do it. I don't know if that's all worked through. Um, so that's kind of more the office space. I mean, some of the commercial space. I mean, in Cleveland, Ohio, I can tell you they're building condos everywhere. So I'm cautious on the real estate as a whole. I think some areas are a little better than others, um, but we're underway it, and I can show that later on one of our slides. And I don't see us changing that. At the very least between now and the end of the year, I don't think that's going to change anytime, probably in the next 12 months. But just to put it in shorter terms, I don't see us changing that. So um, eventually those things will all reset and there'll be a shaking out of that process. And maybe some of that's already happened, but I do think just because people sign 4 or 5 year leases, it takes a little longer to do that.
Okay, thank you, John. Here's another one. This is a very good one. With the current tight labor market being one of the major drivers of inflation and no influx of workers into our country through immigration reform, is the Fed's hand forced to crash the economy to bring inflation to 2%?
Well, I'm not convinced they're going to take inflation at 2%. I think there is some wiggle room there, and there's been some comments about now officially they'll tell you 2% is the target. That's always been their target. They're sticking to their target. But I don't think they're going to tighten the economy all the way until we see 2%. And I think not to get too far ahead here, but I don't think they're going to raise rates again this year. And I'm becoming more increasingly confident to think that they're done raising rates. So um, I do think inflation's coming down. I don't know if it has to get to 2%. If they have to push hard to get to 2%, to the person who asked the question, there's a better likelihood that the economy would definitely go into recession if they have to continue to tighten the Fed funds rates at 5.5, if they have to go to 6.5 or something to get it there, and that's the only reason they're doing it. And I think there's a possibility that happens. I don't think. I think if they get anywhere with a 2 handle on it, they're going to say close enough. And I think we're not that far from there. But the last 3.7% inflation to get down to call it 2.7, it's going to be much harder than it was earlier when we were dropping off bigger numbers last year and picking up smaller numbers this year. So um, I don't think the Fed will. I guess the end result is I don't think the Fed's willing to cause a severe recession to get to 2%. If it's a little blip in the soft landing to get there, then maybe that's the case. But I don't think they're going to push as hard as people think to get just to 2%. If it's 2.25, 2.75, 2.5, I think they're going to say it's pretty close, and we're going to keep an eye on it.
Thank you. This is very encouraging. So I'm glad we're addressing these. These seem to be the most frequently asked questions that I'm hearing from clients.
Sure. So I'm going to keep, but we can ask more as we go.
Yeah.
And if you have one in the middle, just yell it out. So valuations have been a big concern. We've seen a little bit of a pullback. I think still remain elevated. Obviously, that 25-year average is about 16 times, or a little over 16, almost 17 times earnings. And this is on a forward basis, so the next 12 months. Right now, we're seeing the PE, or price to earnings ratio, finish the quarter at 17.8. Probably about where it is today. I personally think the earnings will continue to rise over the next 12 months. I mean, I think we're through the worst of it. So if that's the case, that'll help keep the ratio or the price to earnings down. But even so, at 17.5, call it 17.8, 17.5. This whole thing called the rule of 20. That kind of puts inflation somewhere around 2.5, which goes back to our discussion a few minutes ago, that if we can get inflation down to 2.5 between now and end of next year, that's kind of where it's forecasting. And I think that's doable. So, concerned about how elevated valuations are, but I wouldn't. I'm not overly concerned at this point. So so I already said this once, so I'll keep this short. I think the Fed is likely done raising rates for the year. We talked about this before, but they want to get the Fed funds rate above the inflation rate or the CPI. And as you can see in the lower right there with the circle around it, we're at 3.7 now, and Fed funds rates at 5.5, so we're well above it. And they've been much more moderate in their pace. They've done a couple 25 basis points. They've done a couple pauses. I think they pause again in November. December is still up in the air, but if you look at the forecast out there or the futures, there's no more rate increases baked into the futures. In fact, the next action would be a cut in June. So I think it's a little early to start talking about cutting rates. And then there's a thought out there that it's going to be higher for longer, and that may be the case. But I think as far as the Fed funds rate moving up, I think if we're not done, we're really close to being done. I think there's probably no more than maybe one more 25 basis point hike. Credit spreads remain firm, as you can see here. The BAA spreads are well behaved, and why that's important. It tends to be a pretty good barometer of the economy. If spreads start to widen, that means there's a concern about higher bankruptcies and harder to get credit. And then spreads rise, and it's usually a precursor to a slowing of the economy. As you can see by the dotted line there in the lower right, spreads continue to come down. But even if they get above that 200 basis point spread, which would be in this area here, 2 to 250, it's still not too bad. If they get above that range, then I think we have to start being concerned that maybe that's foreshadowing something with the economy going forward. Talked about earnings already as well, but again, we see earnings. This is a chart from Evercore ISI, and third quarter earnings came in on an annualized rate about 230. It was supposed to be about 222. We just started getting earnings for the third quarter here. So JP Morgan was out today, and Citigroup, BlackRock, a couple of the bigger banks, and earnings, I think overall were pretty good. So I think it's a good start to the quarter or the reporting season. I like to talk about seasonality every once in a while, and I kind of alluded to this earlier, but November and December tend to be very good. So November, December. September is probably the one that has historically not been very good. We kind of weathered the storm there. We're in October, as you can see in the left there, November, December, and then really into January at the top tends to be a pretty good run into the market, into the close of the fourth quarter. If you look to the right, from a percentage standpoint, it's anywhere from 67 to 77. Again, tends to be the two best quarters relative to the hit rate or the percentage of positive returns for the month. So, we're kind of entering that seasonally strong period going forward. It doesn't always work in the markets, and sometimes you have pullbacks, but it tends to work and work pretty well if you have a positive year going into the end. So that's kind of where we're at. Talk a little bit about our portfolios coming up, but in positioning, I know you asked a little about real estate, and I'll touch on that again. But any other questions or comments out there?
Okay, so going back to that previous slide, everything you are saying is indicating like it's that we should expect a pretty positive November and December. We could. Anything going on in Israel, fear of government shutdown, is there any risks to the markets today that could?
Well, like I said earlier, there's always risks out there, right? I mean, there's never been a perfect time to get into the market, right? Or you wake up and there's no issues going on, there's no political drama, rates are low, everybody's happy, and it's like the perfect day to buy into the market. So you don't have those. And I think if you kind of wait around waiting for the perfect day, waiting for the Fed to stop the raising rates and wait for Israel to finish the military action You're waiting for Russia to pull out of the Ukraine. You're waiting for the Fed to stop raising the rates. You're waiting for inflation to get to 2%. You're probably going to miss it, or you won't ever, or will never get there. One of the two. So I get the point, and I understand the volatility and concerns from clients, but I think waiting for the opportune moment to kind of market time never really works out too well. So I think, yeah, sure, there's a lot of concerns out there. We've touched on a lot of them. The military conflicts out there, the direction of interest rates, they've moved up, the higher cost of mortgages. I can go down the list, but that's kind of the wall of worry that I talked about earlier. And I think you want to buy in when the worry's high, because if the worry's low, then you've probably already missed the move up. So I don't get too concerned by those things. As our clients have heard us say, we're long-term investors. We're not really looking to time entries into the market. I think there's a big belief that it's time in the market, not timing the market. So sure, there's things we keep a close eye on. We talked about the speaker race. We talked about the budget impasse. So there's enough to worry about, but I wouldn't be staying out of the market.
Okay, thank you. I think that's it. We can keep
Okay.
going. The rest of the questions will have to do with portfolio and
Okay.
sectors and things like that.
We talked a little bit about this. You asked about real estate. So as you can see here within our large cap portfolios, we're real estate here. We're about 0.5% below the benchmark, and that's kind of where we've been consistently. We've been adding to technology names. We're still about right on equal weight. Still overweight industrials. Utilities and financials have been under pressure. Those are areas we've been underweight, and I got a couple slides why, but a big portion of that is because of the way interest rates have been. So, here utilities remain under pressure as rates rise. It does get into that position where if I can get 5% yield on a 2-year treasury or even a 6-month treasury, and I'm buying utilities for a 3.5% dividend, it's not as attractive as it used to be. So I think we've seen a big pullback, mainly as rates have risen here for utilities. We have a little bit of a bounce here. We could see a higher bounce. I think there's a chance rates might, come down somewhat here between now and the end of the year. I don't think there's going to be a big move down, but I do think, this is kind of just a bounce in a downward trend. And you could say the same thing about banks. They're under pressure as well. And again, it's more the regional banks. So like the PNCs, the Keys, the Comerica's, I'm not picking any out for any reason. Huntington Banks, those type of banks, they have come under pressure really because, again, rates are rising. Has to do more for balance sheets than anything else. So, relative banks to the S&P 500, which is this bottom chart, we had a big drop down in March and April because of some of the banks that went bankrupt or had to be closed. It's been kind of moving sideways, but it looks like it's creating another leg down as rates moved up here. I think it was 488 yesterday or last week on the 10-year Treasury. So those are areas that we've been underweight. I think we'll stay underweight at least into the end of the year. Maybe take another look at them once the Fed has announced they're done raising rates, and we start to think there's more of a opportunity for rates to start to come back down, at least on the Fed funds rate. But I think that's still a little bit off. So from the international standpoint, China's been in the headlines quite a bit. One of the areas of conflict out there that we were talking about earlier with global geopolitical issues is China and Taiwan and what's going to happen there. They had a reopening from their COVID lockdown, which lasted much longer than ours. But, they're still struggling. A lot of it is population driven. I mean, their population is getting older, and, there's a fear they become the next Japan as far as just aging population. But I think one of the bright spots out there is India. Their working age population is much higher, and it's getting bigger. China has been an area. I know Apple, for example, is looking to move a lot of their manufacturing out of China into India. So I think that's one of the areas of the emerging market that's looking pretty attractive. And I think you'll see, become a bigger part of the index as we move forward. Um, uh, I don't know if you asked a question on small caps, but one of the things about small caps that they've kind of bounced around here. The three blue arrows right here that the Russell 2000, which tends to be an index on small caps, have just been bouncing around from a price standpoint. It's kind of important to hold this trend line there, because as you can see versus the S&P, it's been down. I think one of the reasons or questions, why? Well, I think there are a couple things. One, seasonality speaking, as markets tend to do well in the fourth quarter, small caps tend to do even better. So we're at that point, and hopefully that'll be a positive going forward. But I think a lot of it is interest rate cost and access to capital or access to credit. Right? The areas you see get tighter first would be with the smaller companies. The Exxons and the Apples and the Costco's of the world can always get access to funding, and they get the best rates out there, where the smaller names tend to struggle more. And there's a lot of banks in the small cap index, a lot of small community banks, that has 10 or 20 branches in local areas. We have them all over here in Ohio. They have been under pressure a lot, and they tend to make up a pretty large portion of the small cap. So, much like I mentioned earlier with banking, I think the small caps kind of fall in that same bucket. Showed this chart before. Last time I showed it, we were in a gray area down here where returns are somewhat muted going forward, but we're really close to that point where over the next 3 months, you see better than average returns. That kind of goes back to the discussion with November, December, January coming up. So nothing's really changed there, except I do think we kind of get this as I like to call them, a tailwind into the end of the season, end of the year. Nothing's really changed on either one of these. They're very consistent. Growth has outperformed value pretty much since the end of the year. December, we had a big value over growth period last year. It more or less changed on a dime in December, and has been going straight up there on the left-hand side. Same with small caps, really. You had a little bit of I wouldn't even call it a rally, but a little bit of a consolidation versus large caps, and large caps have just really taken over. Kind of the opposite of last year. So I don't know if those trends change anytime soon. We've definitely had a little bit more of a growthier portfolio than we have versus value. And again, we're somewhat cautious on small caps, but we're hoping that seasonality can kick in. I love these charts. So, if you look at the beginning of 2024, which is not that far away now, first quarter, off the next 4 to 5 months. These are predictions from fixed income analysts out there and investment banks like Wells Fargo and Citigroup and those about where they see the 10-year Treasury yield forecast. So as you can see, there are 47 forecasters, and I'm looking at the reddish bars right now. That's the next quarter of 24. No one is predicting that the 10-year Treasury can be at 5% or more. I'm not predicting it's going to be at 5%. I don't know if it will get there or not. But the fact that no one is forecasting it, and most people have been wrong on the direction of interest rates, tell me that you got a better than you think chance of rates rising over the next 3 to 4 months to that 5%. Kind of a yin when everybody else yangs type of approach on that. And we had a conversation with a technical analyst earlier this week, the guy that runs Renmac Research, and they think that the 10 years breaking out, and he wouldn't. It wasn't a high level forecast, but he thought it could easily get to 540. So it'll be interesting to see how rates react over the next few months. We continue to be somewhat short our duration, not as much as we have been in the past, but still short our duration, which tends to help as interest rates rise, and it's been pretty beneficial for our fixed income holdings and for our clients so far this year. Any other questions out there, Dana, or do you have any questions yourself?
You've pretty much answered. There was a question regarding small cap and mid cap stocks underperforming. I think you pretty much answered that.
Caps and small caps kind of go hand in hand, so it's pretty much, would say, the same thing.
Okay. Here's a good one. What's contributing to longer rates rising?
Yeah, that's a great question. And, there's one, um, our deficits are rising, so we're printing more bonds, right? I mean, so supply is going up. That's one thing. That's kind of the old supply and demand argument. So to attract people to buy those bonds, you have to give them higher rates in theory. So that's one. That's stating the obvious. That's happening. I think they said 2023 that the budget deficit will be close to 2 trillion. So as these things get bigger, you got to print more bonds. So that's one. Two, there's been conjecture and some data that suggests that China and Japan have not been buying as much bonds as they used to. So again, you're taking two of the bigger buyers, I wouldn't say out of the market, but they're not as aggressively buying as they did before. And the reasons are not for, it's not really political reasons. The, the feedback was because they're using the money to buy up their own currencies. They're trying to prop up their currencies, so they kind of shifted their focus. So I think those are some areas that you're seeing rates rise. Because again, the Fed only really controls the short end of the curve when they raise Fed funds rate. The longer end, the 5-year, the 10-year, even the 30-year bonds that are out there tend to be more on supply and demand. And I just think that those are kind of the reasons, just more deficit spending, and two of the bigger um, buyers out there maybe pulling back a little bit on how frequently they're making acquisitions or making purchases.
What's your outlook, John, on mortgage rates coming down?
Well, I haven't bought a house in a long time, so I don't pay attention to rates too much. I was one of those guys, and I would say I was lucky more than smart, but I think I locked in my rate at like 280 or something for like a 10-year for 10 years. So um, sometimes it's better to be smart than, or better to be lucky than smart, and I think that's probably one of those things. But anyway, as far as mortgage rates go, they tend to be tied to the 10-year treasury. I mean, that's how they used to be. I know there's various ways of locking those in, but they tend to move in the same direction as the 10-year treasury. So, we've seen rates move up to almost 4.5% from below 4. You've seen 10-year treasury or 30-year mortgages move up to almost, like I said earlier, almost 8%. I think if the 10-year comes down, you'll have an opportunity to see mortgage rates come down. Um, it's a function of the economy like everything else, I guess. And it's mortgage rates are a function of treasuries, so treasuries are moving up.
Okay. Let's see if I've got a good one here. We talk about the healthcare sector. Why has it
Yeah,
underperformed this
I
year?
don't know about great answers, but I'm going to talk about it. Uh,
Any reason for underperformance this year?
um, well, that's one that's been a struggle. I think there's a couple things, and I don't know how anecdotal this is or not, but one, there's a little bit of a pull forward. People out of COVID on 21 and 22 rushed out to get all the new knees and hips put in because they were all backed up. So there's a little bit of that. There's a little bit of, and I think this is a little premature, but there's a lot of these weight loss drugs out there, this Ozempic, and there's another one, I can't think of the name of it, that, the fear is that, especially for the healthcare equipment makers, well, if people all get skinny, there won't be as much pressure on joints, so you won't need new hips and new knees. I don't know if that's going to be the case or not. I've heard that as a reason why, some of these equipment makers and uh, same with cholesterol drugs, you won't need as many of those because you won't be overweight. And so I don't know, we'll see, but they definitely have come under pressure. They haven't performed as well. I think some of it's just risk on versus risk off a little bit this year, and I think some of it is some of the issues with the changing dynamic of weight loss and all that stuff. I tend to think people overeat no matter what. So I think new knees and hips will still be there, but maybe at a lesser pace. Who knows? All right, so let's go into I know we're probably getting late on time here. So, talked a little about this already, so I won't get into too much, but oil tends to peak on the event. Let's kind of buy the news or sell the news type of thing. And with the exception of the 70s, normally, you see oil peak when the event happens. So we had a big run up on oil. It spiked on Monday after the news of the invasion over the weekend, and all the all the military movements, and then it's been kind of stabilizing in here. So we'll see where it goes. That $100 tends to be that big psychological level that people get a little nervous by, but so far it hasn't really affected oil or gas prices. As I mentioned earlier, they're starting to come down. So, it's something we're keeping a close eye on, but I'm not going to be too concerned by. So you asked about the presidential elections and I think change of the House or whatever it might be. Well, I don't know if I can predict that, but there's a lot of polls out there that indicate one, and it's not a political statement. I'm just reading the polls that I think it was 70% of Democrats didn't want President Biden to run for re-election. So that's a tough one for his own base. I think most people don't want either the front runners, Biden or Trump, running because of their age. Trump has a lot of other issues as well, but historically speaking, that third year of the presidential cycle, which we're in today, this year, tends to be pretty well. Now, as we get into this fourth quarter or the fourth year, which is the election year, which will start in January, if you're a president running for re-election, as you can see, markets are about flat historically speaking. But if you're a new president, meaning in your first term, like President Biden would be, you get the big run in the third year, which we're hopefully seeing now and will continue into the end of the year. But you see it spill over or follow through into the fourth year. So that's up. That's the election year. As far as getting into changeover in the House or Senate and those things, I think we're probably pretty far ahead of that. Markets tend to not like change, so I'm sure that'll be an issue. But markets tend to rally into elections. Markets tend to rally as they get close to the election, especially if there's a front runner, and then if not after the elections, because it's more of it's a known quantity at that point. We know who the winner is going to be. We know what their policies are, and how that's going to change. So, history would say we should have some follow through in the next year. I don't know who the nominees will be. My guess is we're pretty far away from that now, and I wouldn't be shocked if the nominees aren't the two front runners we see today. But that's just a hunch. So again, seasonalities, fourth quarter, we're there. Looks pretty good. Hopefully that'll hold hold this year in 2023. Just kind of want to give everybody an update on this one, and I think this might be my last slide. Yeah. I mentioned this a few months ago, but we weren't quite there yet. So when you have a bull market or a bear market, and the bear market officially ended on 12/22, because that's when the market bottomed last year. So literally a few days more than a year ago. S&P was down about 25%, but as we showed earlier, and we weren't quite through the first year, you tend to have a pretty good bounce off that low. Now the problem is you don't know it's really a low until you're a few months into it, but it turned out to be the low. And we did have a 23% increase in the first year. 100% of the time you see an increase on that. And again, that goes back to 1950. But you tend to see a second year rally as well, or continuation of that. And that, again, that's about 100%. So every time that's happened, as you can see all the green numbers. And, roughly it's somewhere between 13 and 14%. I don't know if that's going to be the case, but it kind of lines up with the issue with the presidential cycle. And, so again, I think we have a chance where we're going to see a tailwind into the end of the year, and that'll carry forward the next year. A lot can happen. As we mentioned, there's a lot of geopolitical issues out there. that haven't been settled. Hopefully they won't get worse, they'll get better, but that's always the concern. I know we asked for questions, but if there's any more out there, I'm happy to take them. Or if there's any for Dana, I'm sure she's happy to take them. I have to put out these amendments so everybody sees them. So there they are. Whoops, sorry. So if any other questions out there, Dana, or if not,
I think we're good. I think we've covered everything. But for anybody, if there's anything, you have any further questions, just, please email them to your advisory team. We'll make sure that someone reaches out to you directly. Thanks,
yeah,
John. We appreciate your
I
time.
always say, if you have questions, reach out to them. I'm happy, myself or anybody on the team, up on a WebEx call with you or a Zoom call or whatever's convenient for you guys. So we're always here to help.
So thank you for joining us today. It's our privilege to inspire you and your family. We feel sincere gratitude for your trust and loyalty. Have a wonderful weekend.
Bye. Thank you.